Before I start on investment evolution credit, I recognize some faces in the room, so I'll introduce myself. Some of you may remember me from 3 years ago when I stood up here and I presented a health and wellness business. I'm pleased to tell you that health and wellness business has progressed nicely, and on its books today it has over 20,000 phlebotomists, so it's growing. I remain a shareholder. However, a bigger opportunity has come up, which is where my background rests, hence the reason I'm moving back into consumer finance, and I joined IEC 2 months ago. I've got 38 years experience in consumer finance. I know we've already heard about finance earlier. This is a completely different asset class. This is the consumer, one of the 40 million people out there working a budget that we look to bring into financial services. Investment Evolution Credit is an AI-driven consumer finance company that IPO'd in December 2023. We're on the Aquia Stock Exchange with the ticker IEC. I use the word rehabilitating specifically, rehabilitating borrowers through better technology and fairer product. And rehabilitating is a key word there because the market has changed. There's been tectonic shifts in the consumer finance market over the last 2 years, and that cycle has gone full circle, hence the opportunity of coming into the market. Disclaimer, you've seen 3 or 4 times now. This is exactly the same, just with a different name at the top, so you can read at your leisure. So what's really changed over the last 2 years in consumer finance? Well, there's been a significant regulatory reset of consumer finance. I'm sure you're all familiar with 3, 4, 5 years ago how the market was segmented between payday lending, unsecured loans, very, very high risk guarantor loans, etc. Well, the financial services in 2018 decided to reevaluate unsecured lending and started a supervisory process across payday, high-cost short-term credit, and consumer loans. And that's basically been pretty seismic across the industry, where over 250 companies have exited the market. There's very short supply of lending credit providers across the market today, and a lot, or the majority of the consumer lenders have exited the market because of legacy reasons. However, the demand hasn't changed. In fact, the demand for consumer finance has increased, but the opportunity has reduced significantly. What has happened as a result of that, our borrowers, have gone to unregulated lenders. The pawn shops are regulated, but they've gone through to the pawn shop industry, and they've gone to unregulated lenders. These are the people that you don't want not to pay. They fall out of regulation and they work to their own rules and demands. So the demand is far outstripping supply. The old business models are redundant. You've all seen the branch closures through the banks. You've seen branch closures through many finance houses. And that leaves only a few in the market which enable people to go in and discuss their financial challenges, their financial problems, and solve them through face-to-face interviews and lending. So the old bricks and mortar model is outdated. It's not cost effective, it's not economic, and it's no longer viable. So how do you replace a bricks and mortar opportunity? Well, you do that with innovation, and that's where innovation credit comes in. A bit about us. We IPO'd in the UK in December 23. We have instructed Osborne Clarke to obtain the FCA credit license for us. However, we're in the market looking for acquisitions of acquiring portfolios that have been previously supervised by the FCA. We also have a position across the US. We're in 6 US states today. That covers over 100 million people, and we intend to grow that to 20 states over the foreseeable future, which will give us coverage across 20 states in the US. The previous presentation or the one before that said that the management team had over 150 years, right, in the industry. So do we. We're not copying them. And I'll show you that in a moment. And that's experience in consumer lending, both here in the US. Myself and my colleagues here, we've built consumer finance businesses and we've exited them at the right part of the market. And that's basically what we're doing today. Our whole position is through innovation. The technology and the availability of data in the UK and in the US has been exponential over the last couple of years. And the availability of that data and being able to harness that data enables us to operate on a different low-cost model where legacy companies and legacy operators will not be able to follow. Lending remains highly attractive because of its available returns and available margins. Okay, let's have a look at the market. Does anyone know here the two oldest professions in the world? Judging by the laugh, yes, right? Two oldest professions. Money lending to the consumer, do you know it dates back, and records show it dates back over 4,000 years. In Mesopotamia, farmers were lending money to people like payday lending, right? 4,000 years later, consumer finance has gone through a complete cycle where reapplying regulation has taken most of the lenders, out of the market, right? It goes in cycles, right? And that cycle now means that there's a door open for a new, innovative, low-cost lender to come to the market, right, and provide credit facilities to the underserved consumers. In the market today, right, there's around 230 billion of unsecured lending in the market today, and that excludes consumer loans. It's a large market in the UK. That grew, right, over a previous month of 863 million and 14 billion compared to last year. So the market is growing, but that market is growing for what's called prime customers. They're bank-related customers that can obtain credit because they've got very clear credit ratings and credit history. There are significant, I say there are around 10 million people here that are non-prime customers. The reality is that's more like 15 million today because of people's credit history through the energy crisis and through going to unregulated lenders and some of the challenges that people have experienced over the last two years. And the key thing to point out on this is today, your credit profile, your credit risk profile should be treated as an asset. Not just because you need it to borrow money, but if you think about it, to get a mobile phone today, right, they credit score you, right? And they credit search you. It's called a soft search, so it doesn't show on your records. You apply for a new gas account, energy account. Most things that you apply for today, you get credit searched, right? And if your credit search doesn't stack up, right, you don't get a mobile phone, right? Or you get a mobile phone that's not on a plan, so you're paying significantly higher costs. So you have a damaged credit rating, you actually end up paying more for most of the services and most of the utilities that you use because of your poor risk profile. So what we're all about is how do we rebuild and reset people up to help them build their credit profile, to help build their assets so they can operate, right, normally without being excluded from mobile phones, from utility accounts, etc. And that's this sort of size of market, right? People who, through no problem of their own, right, have fallen into debt that they can't sustain. They've gone to debt management companies, or they've buried their head in the sand and been sued and gone, attracted county court judgments. They've got poor credit history, or they have no credit history. Over the last couple of years, there's been significant immigration into the UK, right? We'd like that growing population to provide and to be able to work, right, and live in society. But without any credit history, without any credit bureau, how do they do that? They can't. So it becomes a vicious circle. And there are around 8 million people in the UK today that do not have access to banking facilities and build up a credit profile, which is a significant challenge that needs to be addressed. The market is there. What happens, sorry, wrong way. What happens today when people have a problem, a bump in the road, right? Our role is to protect these vulnerable customers and help them over those bumps in the road by providing lending facilities to enable them to spread the payments. Right? The last data I saw showed 18 million people, right, were in arrears with one of their accounts, be it a utility account, a mobile phone bill, something else. People are living to budgets, right? And they're living to very stressed budgets, right? Any bump in the road, the car breaks down, how do I get to work? Yeah. Divorce, right? Paying for a divorce, very expensive these days, especially when children are around. Sickness, right? Not being able to work. Going down onto statutory sick pay. There are significant challenges in the market today for people on tight budgets. And most of the emails I get in from people who are looking to solve their problem, that's in the subject box. Right? That's why I put it in there, help. Right? It's not, I need to borrow money. It's not, I need to buy a new car. It's not, I'm looking at going on holiday. It's help, right? Because there is insufficient help out there of helping people in these challenges. That is the average debt per adult, right? Not per household. That's the average unsecured debt, right, in the UK today, per individual. Surprising? 57% of people, adults, use some form of credit in the UK today, right? 53%, this blows my mind, 53% of people who use buy now, pay later, pay late fees. Okay. So UK consumers are used to using credit. It's part of society. Can everyone remember Provident? Provident. My grandmother used Provident. In fact, my grandmother used to ask me to hide behind the sofa when the Provident lady came round. Right? But again, Provident had been around 148 years, but it couldn't meet the new regulatory requirements. So it's ceased trading after 148 years. Right? But the Provident lady coming round, the unsecured consumer lending, part of society, people used it and still use it to manage their budgets and to help them with unforeseen circumstances. How the market looks today, here are a couple of the lenders left. I haven't got everyone in here and I haven't got buy now, pay later in. But there's a couple here just to make the point. Buy now, pay later. Everyone's heard of Klarna. Right? Klarna have raised 4.3 billion over 35 raises, right, since inception. It was valued back in 2023 at 46 billion. Looked at IPOing, stopped IPOing, or stopped the IPO process earlier this year and struggled with its final raise. Right, 150 million customers, but the FCA, it was unregulated, and the FCA now have regulation, right, over buy now, pay later. So there's going to be considerable changes in the buy now, pay later market. And so they should. I bought a pizza on Domino's the other day, and it asked me if I wanted to spread the payment over 3 months, like £1.50. Domino's pizza, for goodness sake, right? And it was £1.80 with pepperoni. Crazy, right? This is a branch network, right? Unsustainable, right? Everyday loans, right? They have 70-odd branches in the UK. Now, they're charging interest rates of 99.9%, right? Just to try and cover their operating costs, right? And they're struggling. H&T, pawnbroker. Nothing wrong in pawnbrokers, Large branch network, very expensive, right, to operate. High cost short-term credit, right? These are up at 1,200% APR. Yeah, but it's still less than getting your knees broken, right, if you don't pay through an unregulated lender. Very, very high cost, right? You've got guarantor loans. Most, they're so heavily regulated today, there's very little to zero lending on unsecured loans. And I haven't put credit cards on here. You're all familiar with credit cards. So these lenders here, all of these were pre the FCA changes. The FCA have the FCA reapplied the regulation. They've all got legacy portfolios. And because the FCA retrospectively applied those rules, they're all having to pay redress, right, to the consumer. So you look at a company like Amigos, you may have heard, highly profitable company, very high ratings from the consumer. They're now basically out of business, all right? No lending, right, because they can't meet the FCA criteria. This is a letter, I wanted to share this with you. This was a letter that the FCA recently sent. The consumer lending market is essential to the UK economy. Yep, it is, because if people are not spending, right, it's not helping the economy. And the new government, right, is determined to drive spending powers, the consumerism, to start driving the economy. Without consumer finance in place, it can't happen, because the vast majority of people can't spend money, right, because they haven't got it. We want to support a thriving and innovative consumer lending market, investment evolution credit, where people have access, right? Data shows high cross market has reduced significantly since 2019, down by almost £3 billion of lending, right? 250 firms exit the market. Growth in pawnbrokers, right, and new lending, up by 100 million. 200,000, and I'll correct that because that was in 2022, right? 500,000 people have taken credit from an unregulated lender. And that can't happen, right? And it's got to stop. So, the FCA, we encourage you to think about what you can do to innovate and provide greater access to affordable loans. So, the FCA now have a clear direction. They fully regulate regulated unsecured personal loans. So the market is now either out of operating because 250 have exited the market, or they're spending all of their time and resources recompensing customers from legacy portfolios. So the opportunity for a new lender to come in is now, right? With a low-cost operating model, right, and a strong proposition. Our business model is we acquire customers from a number of different sources. Acquiring customers in this market is easy, right, because there's not a oversupply. We underwrite using a number of different processes, which I'll cover in a moment, that's overwritten by AI and credit checks, but we do not lend, right, inappropriately. So if you cannot afford to pay it over a period of time, you don't get it, right? If you have addictive behavior, and we can tell whether you've got addictive behavior now because we've got advanced credit bureaus and open banking. So if you show addictive behaviors, you don't get the money, all right? And we make sure that we follow customer duty. And this all comes down to AI. And I'm proud to say we've got probably one of the cornerstones of the AI industry on our management team. I won't ask him to stand up, but he's the guru of AI. He's part of our team, and we're looking at how do we utilize the AI across all of the different segments of consumer lending, right, to manage the operational costs. A typical example on AI across lending, real-time data. Demographic data, credit bureaus. Most companies will use one credit bureau. We're looking at using multiple credit bureaus because each have different strengths and weaknesses. The credit scoring, algorithms, behavioral model, fraud databases. But the thing that no one's using today is audio and video, right? And you think back to what I mentioned earlier about the bricks and mortar. Bricks and mortar had value when you were doing face-to-face interviews, but you don't need to do that today. You can use FaceTime, you can use Teams, you can use Zoom. They're all out there. And even more importantly, there's technology available that will assess the person when you're speaking to them and tell you whether they're telling the truth or not. Right? Spooky. Right? And the amount of data that you can obtain out there is really quite... There are many companies, we're not inventing something new. There are many companies out there across each of the areas that are developing AI products, that are developing the technology. What our ability is to bring this all together, right, into one operating model. So the timing's right for a market entrant. I can see I'm out of time, so I'll speed up. We are looking at acquiring portfolios in the UK as well as growing organically, but we're also looking at raising debt funding to accelerate growth across the US. The US market is exciting. We can cover 2/3 of the population very quickly, and that's in excess of 150 million people that should be looking at our product. We operate in a very customer-centric risk management framework, bearing in mind what I talked about on the regulatory piece. We have some very skilled individuals making sure that we meet the regulatory guidelines across the risk universe. We have a very robust strategy for growth on the technology side, and developing the training and learning for the consumer. I mentioned earlier the branch network. They provided good instruction, training, development for the consumer. We can replicate that through apps on the mobile phone. Team, huge experience, over 150 years of building consumer finance businesses. Dr. Richard Lever, over 41 years in the industry. I'm going to have him DNA tested because I don't believe he's 41 years. He looks too young, right? But 41 years in the industry, looking at building our AI piece. Business is profitable, over 250,000 PBT. We just finished a raise and raised some more cash. So operational cash is not the priority. It's building the debt funding and the access to debt funding to accelerate the growth. So we've got a fantastic management team. We've got a 14-year track record in the US. We've got high margins, right? We've got the capacity to scale very quickly to over 100 million, right? And the time is absolutely right now because we're on the front foot of what will be a new growing market at the backside of the regulation oversight. That's it.
Thank you very much, Mark. Terrific. Okay, questions for Mark, please. I can see a hand down here with Ed. Chris, please. Thank you.
Yes, I have got equity.
Rachel Reeves is trying hard to make me a customer of yours, but I haven't quite got there yet. So looking from an investor's perspective, I looked at what figures I could find before this presentation. And from an investor's point of view, there are a couple of things that struck me.
Yep.
The first of which was that the share price at its height has been 85 pence and its low was, I think, 4.5 pence or somewhere thereabouts, which is significantly volatile.
Yep.
Which means that there seem to be opportunities to make money with your business, possibly, or lose it. And I should be interested in your comments on that range and its origins. The second question is that if I was to buy your shares today, the bid-offer spread is between 10 and 15 pence. So effectively, I'd need to make a 50% uplift to break even. And I wonder, in light of that, if you can comment on the Aquis Stock Exchange and whether you would be better placed elsewhere from the point of view that I don't recall having seen a bid-offer spread so high.
No, I'm not going to answer the last question for Aquis. A lot of this, that position happened before I joined. As with any, I would say, relatively new position, as you're raising capital, there's always going to be that volatility at that stage until you gain stability through your portfolio and growth and investors. And if you look at that data that you provided, I think there's probably only 3 or 4 trades that have created that volatility. And the reason, again, why I'm here today is to present the business, to look at getting more of you guys trading on the stock, right, to, again, help that stability. Aquis has an interesting position, as you know, but I think they just recently announced they're merging with SIX, right? So there'll be a completely, I would suggest, change to improve liquidity in Aquis stock.
Thank you.
A question over here, please. Just here, Chris.
Sorry.
Hello, thank you for the presentation. Sorry, I'd just like to, I've got a question as well, but I'm just going to comment. I think it's exciting times with Aquis. I'd just like to echo that and also suggest that maybe if you get a quote, the spread might be a bit narrower than the published price. Okay, so a big risk for any financial company right now is the FCA.
Yes.
They're very erratic, unpredictable. They seem to get something between their teeth and they seem to go for companies or sectors. So could you comment on the risk of that? And also on the same subject, the courts, we're now having problems with the courts with this motor case. Was it Hopwood, is that right?
Yeah.
So it does seem to be quite a risky area. How do you mitigate that? And do you have any other comments?
Great question. Thanks for that. I'll answer it a number of ways. Firstly, I've been out of the market for several, or 3 or 4 years after selling the business, seeing what was happening on the regulatory piece, and decided to stay out because, quite frankly, it was carnage. There's no other way to phrase it. Myself and a couple of colleagues are back in the market now because we think that cycle has completed on unsecured lending. Most of the unscrupulous lenders, most of the bad lenders, right, are out of the market. Some good ones are still operating redress because of challenges that they've come under with the FCA that, again, has been a little bit poetic in the way it's interpreted some rules that were previously okay, right, and retrospectively applied those. But again, on the consumer lending piece now, if you look at all of the noise coming from the FCA today, it's balanced across, I would say, 2 areas. One is we've done our job in consumer finance and unsecured loans. We've cleaned that up. Now we need to attract consumerism. We need to attract more companies into the market on using innovation around customer duty. And they brought customer duty in 2023. The other piece is, what are the FCA talking about now? Car finance. Car finance, there's going to be some real interesting outcomes of that, varying from billions to what have you. The recent court case made a judgment which was if you have received a commission and you haven't disclosed it, right, then it's unfair and you have to refund the commission with interest. Okay. Now the challenge is, right, it doesn't just cover motor finance. That it's a blanket statement, right? So that literally covers everything and anything. You buy a washing machine and someone's been paid commission for selling you a washing machine or TV. The decision and that communication is unbelievable. I mean, that would take a lot of very, very big organizations down if that stayed correct. My personal belief is, I think they were applying it to motor finance, but they didn't state that, so it's been taken that if it doesn't change, it's going to cover everything. I think it's now become political. You mentioned Rachel Reeves. You can't make that statement because, disclosing any commission or you've got to pay it back and do that retrospectively, well, you can imagine what that means. So FCA now are focused on motor finance and bringing the regulation to motor finance, and they've also just taken over buy now, pay later. And I'm sure they're not going to allow people to spread the cost of a pizza over 3 months, which is unbelievable. Right.
And we were about out of time, but one quick final one from me, if that's okay, just to get in potential investors' minds. Key milestones the next 12 months, what are the things to look out for? What are you hoping to achieve?
I want to get an acquisition of a portfolio under our belt very quickly, and I want to have the platform operating so that we can evidence how the access to that umbrella of information that's available and the umbrella of technology that's available today, we can show it operating, right, and show how that can change the market on a very low cost piece. But primarily, you know, my personal aim is to stop people going to unregulated lenders. It shouldn't happen.
Mark, thank you very much indeed. That's great. Thank you.